How are things now? My name is Paddy, and welcome to the 6th episode of my podcast, Finding Cashflow. On today's episode, I want to speak about what I believe to be the epicenter of the Canadian real estate bubble, which in my opinion is the Toronto pre-construction condo market. When we read reports and updates from the various real estate boards across the country, we're reading about the resale market for the most part. We're reading about units that were placed on the MLS, which is the Multiple Listings Service. The MLS is an online database which is run by local real estate boards across the country in conjunction with CREA, which is the Canadian Real Estate Association. But in this episode, we're going to focus on a very specific area within the Canadian real estate market. The product we're going to speak of today would have predominantly not been sold on the MLS. It would have been sold in presentation centres and sales offices across the city of Toronto, in sales transactions which were typically just between the developers and the people purchasing these units. As these units were not on the MLS, they therefore would have been sold without any involvement from CREA or any of the regional boards such as TREB, which is the Toronto Region Real Estate Board. And therefore, the sales dynamics within this sector of the market are far more hidden from the public, and they're far less commonly spoken about by other real estate podcasters who mainly focus on the MLS data. Now, before I speak about the current landscape within the pre-construction condo market, meaning before we speak about the current dynamics between supply and demand within that market, I want to first explain how the pre-construction condo market operates and how it has evolved over the last few years. Pre-selling condos became very popular in the late 2000s and early 2010s, as our country significantly ramped up its construction of apartments and condos to levels which we'd never seen before in the history of the construction industry across our country. You may remember this slide from the second episode of this podcast, where we looked at the supply of new construction homes in Canada dating back to the mid-1950s. In the red circle on the right-hand side is where we can see the explosion in apartment and condo construction in Canada, starting at the turn of the century and ramping up massively right up until recent years. The pre-selling of these units, before construction had even begun on these units, quickly became the most common way for the developers to obtain financing from the banks to finance the construction of their projects. Once a certain percentage of the units were pre-sold, usually around 70%, then the developers could go to the bank to get financing, and construction could be commenced. And back in the 2000s and the early 2010s, these pre-sale units were typically sold at a discount to new and existing units that were on the market. Selling these pre-sale units at a discount made sense because if someone were to buy a newly completed unit, they'd have a home that they could live in or rent out right away. Whereas if they were to purchase a pre-sale unit on which the construction hadn't even begun, they'd have to wait a number of years before they'd receive occupancy of the unit and before they could live in the unit. And having to wait 4 to 6 years between the time of signing the contract to purchase these units and receiving the completed unit was fairly common. And this wait time has become even longer in more recent years. And it was because of this wait time that these pre-sale units were originally sold at a discount. It was also because of this wait time that these pre-sale units became very popular with investors as opposed to end users. An end user would be someone who is purchasing the unit to live in themselves, and they are therefore a lot more likely to purchase a unit that they can live in right away. Whereas an investor could be quite happy to purchase a unit that they wouldn't be receiving occupancy of for a number of years. In fact, from an investor point of view, there was many advantages of buying these pre-sale units. Firstly, the deposit was normally paid across a number of installments over a period of time, so investors didn't have to have the full deposit up front. They also had a number of years to prepare before they had to take out the mortgage for these units, with the mortgage being taken out upon completion of the unit, which once again was usually around 4 to 6 years away from signing the contract. And this gave investors time to prepare for when they needed to take out the mortgage. Then, as the entire Toronto region experienced a housing boom in the mid-2010s, in this chart we are looking at the increase in average home prices across TREB's entire jurisdiction for all home types, the pricing of these pre-construction condos followed suit. Another example of the massive price gains in the condo market at this time could be seen in downtown Vancouver, where average condo prices increased by 75% in the 3 years between January 2015 and January 2018. And with such significant and rapid price gains, the purchasers of these pre-construction condos found themselves in a situation where the condo that they'd signed a contract to purchase a few years prior was now worth far more by the time that they were receiving occupancy of their completed condo. And from an investor point of view, this was a fantastic success. They were now going to be taking possession of a unit at a substantial discount compared with current market values. And it was because of this dynamic, with a sustained trend in prices going up so substantially in the MLS market, that the pre-construction market switched from selling these units at a discount to current day market values to selling these units at a premium. And at the peak, especially in 21 and 22, it was very common in Toronto and Vancouver for these pre-construction condos to be sold at a 30% premium to current day market value. With condo prices in Toronto going up over 22% between Q1 of 2021 and Q1 of 2022, it was very easy to imagine that prices would go up by at least another 30% over the next 4 years. So, up until 2022, investors remained to be very happy to pay these elevated prices for these units, to pay this 30% premium for these pre-construction units that they were signing a contract to purchase. They were doing this with the expectation that the value of these units would have increased by far more than 30% in the 4+ years that it took to complete these units. This equated to about a 7% increase in prices per year, but at this time the market was far exceeding 7% price gains per year, and investors were confident that this was going to continue. And they still believed that they were signing the contract to purchase a unit that they would be receiving at a discount by the time the unit was complete and they would have to close on the unit. So even at these elevated prices in 2021 and early 2022, the demand from investors for pre-construction condos in cities such as Toronto and Vancouver was rampant. Pre-construction condo sales in Toronto got back to the all-time record highs they had seen in 2017. And in Vancouver, sales far surpassed the record highs seen in 2017 and 2018 by almost another 50% by 2021. And the construction industry experienced an unprecedented boom, with the rate of condo starts, which were already at very elevated levels, accelerating even more quickly. Presentation centres sold out entire buildings in a matter of weeks. And the number of units which were under construction exploded also, and reached levels that were 2.5 times those seen in 1973, which was the year before Canada broke its current record for overall housing unit completions. And as I mentioned in the very first episode of this podcast, I believe that we're going to smash this 50-year-old record for completions this year. Toronto commonly held the number 1 spot in North America with regards to the amount of construction cranes in the sky, and a record number of 240 cranes was recorded in Q3 of 2023. And this is at a time where it is said that the amount of overall units under construction across our country was at its peak. Toronto was often far ahead of LA, which was often in second place for the amount of cranes in the sky, and it commonly had over 5 times the amount of cranes as other major US cities such as Seattle. So, with such rapid price gains in the pre-construction condo market, over time it became quite common for some investors to purchase these units with the intent of reselling them or assigning the contract for these units a few years later before construction was complete. And at the peak in pricing in 21 and 22, it wasn't at all uncommon for some of these investors to make a quick and easy $100,000 profit by doing so. So the signing of these contracts with the intent of reselling or assigning the contracts at a later stage before construction was complete became an extremely lucrative endeavour. And the success and the substantial profits made by doing so was commonly spoken about around dinner tables, as well as at parties and gatherings with families and friends around Toronto and Vancouver. Needless to say, the developers heard of these large profits as well. Essentially what the developers were doing was they were selling these contracts to investors, only to see these same investors reselling or signing these contracts a few years later and making substantial profits. So naturally the developers held off on selling the units that they didn't need to sell. It simply didn't make sense to sell an asset which was expected to go up in value by about 30% over the next 4 years or so. For the developers, holding back on selling these units at the time where prices were going up so rapidly was as lucrative as holding your money in a very high-interest savings account, where you were being paid about a 7% annual interest rate per year. By putting ourselves in the shoes of the developer, it is easy to see why they would have held back as much inventory as they possibly could. As mentioned already, the developers had to sell about 70% of the units to get financing from the bank. So, often at the peak in 21 and 22, the developers would sell the 70% of units they were required in order to get finance from the bank, and then they would hold off on perhaps selling the other 30% of the units until the project was nearing completion. And now, this has resulted in a huge volume of unsold units across the condo industry. in the planning stage, under construction, nearing completion, as well as already complete. And the number of unsold units across the Toronto region is said by Urban Nation to be in the realm of 24,000 units. And this is a situation that I've been concerned about for a number of years. And many friends here in Vancouver will remember me telling them stories of me driving around the Lower Mainland to try and monitor these newly constructed buildings, to try and assess how many units may be unsold. You can do this yourself by standing a number of blocks away from these towers, and you'll be able to see that these newly constructed towers have many units in which the blinds simply never open. And by monitoring these units over a period of a few months, I was able to see that around 30% of these units were indeed unoccupied, and therefore presumably a lot of them were unsold. So the pre-sale condo market enabled developers to quickly and easily get financing for new projects, as well as enabling investors to make substantial price gains and profits on the units that they purchased. So that this model of pre-selling the units worked extremely well for both developers and investors for a considerable length of time. But then we saw an immediate and dramatic cooling in the pre-construction condo market in Q2 of 2022, as the Fed and the BOC began their rate hiking journeys. And sales figures for pre-construction condos in Toronto have been at multi-decade lows for the past 2 years now, and currently sales are at 30-year lows. As resale prices were no longer rising, it all of a sudden didn't make sense to pay 30% above current market values for pre-sale condos. And when we look at the resale market or the MLS market across the Toronto region or across Canada overall, we'll see that ever since it peaked in Q2 of 2022, that we've had much lower demand than normal, but also we've had lower inventory. And I've been very adamant from the very start that it's always been a question of what is going to return first, supply or demand. And to me, this is still the main question that we need to be asking ourselves today. And this is the question that we're going to ask ourselves at the end of this episode. From previous episodes, we already know the future direction of supply, and we can already see this in the data right now as inventory or supply is at elevated levels, where demand is remaining to be at very suppressed levels. And we're going to ask ourselves if we believe demand is going to come back in the Toronto new construction condo market or not. And we're going to do this by putting ourselves in the shoes of a buyer in this transaction, putting ourselves in the position of a buyer of a new construction condo in the Toronto market. This is a method that we used in the last episode also, as we try to understand the bond market more deeply, as we put ourselves in the shoes of the buyer in the bond market. And ever since rates started to rise, I've been adamant that demand simply cannot get back to the elevated levels that we saw in 21 and 22. This is due to interest rates being substantially higher now than they were back then. Increased interest rates kill affordability. This is something that can be proven mathematically. This is a screenshot from the Excel we went through in the very first episode of this podcast. I will ask you to focus on the price of $770,000, as well as the interest rate of 1.5%. And we will see that the total monthly carrying cost is just shy of $3,100. And now we will take the interest rate from 1.5% to 5.5%. And we will see that the total monthly carrying cost will remain essentially the same, in conjunction with a decline in price by 1/3, by 33%, from $770,000 to $513,000. So, with all else being equal, by altering just the interest rates and price, we can see that the price will drop by 33% when rates go from 1.5% to 5.5%. All else being equal is a phrase which originates in economics, and it dates as far back as the 17th century. Because in economics, there can be many different variables which affect the outcome of a market. But all else being equal is a method which allows us to check the effect that having one variable in an equation change will have on another variable by keeping all other inputs and variables the same. And in the example we looked at, we kept all our variables the same, such as condo fees and taxes and insurance. But really what we're keeping the same is the total monthly carrying cost. And by keeping the total monthly carrying cost the same, really what we're doing is we're keeping many other things in this scenario the same. What we're doing is we're assuming that we've the same amount of buyers today that we did in 21 and 22, and that these buyers have the same desire to live in and to purchase these units, and they're willing to put the same percentage of their income or their wages towards the monthly carrying costs of these units. But even though we've the same amount of buyers as we did in 21 and 22, and they have the same desire to purchase these units, and they're willing to put the same percentage of their wages towards the carrying cost of these units, this all else being equal technique shows us that by having rates go from 1.5% to 5.5%, that the price needs to come down by 33%, by a third, in order to keep affordability the same. Now, of course, this example was a snapshot in time, and this was the exact example that I used to share with friends when I was explaining how rates change affordability back when rates were a little higher, around 5.5%. But the same theory and equation would still apply today. So this is a very simple but useful example of the all else being equal technique being used in economics. And this shows us how the change in interest rates can substantially change affordability. So now let's go back and look more closely at the current dynamics of demand in the pre-construction market in Toronto. And we will see that new condo sales in Toronto have now fallen by over 90% versus the 10-year average. And they're at lows that haven't been seen since the mid-1990s. And this was at a time where Canada was still in the depths of its most recent substantial housing correction. And at that time, we only had a fraction of the condos and apartments on the market that we have today. So it is no longer a prediction that demand will go away for pre-sale condos in Toronto. Our current situation is that demand has already gone away. And this has not simply been a trend in more recent times. Sure enough, the industry suffered even further when Trump announced these tariffs on Canada, but demand had already fallen by over 80% by then. So if anyone claims that it was the Trump tariffs that killed the pre-sale condo market, this is simply a completely incorrect statement. Demand in this market has been at multi-decade lows for years now. And I'll always remember the stats coming out of the Toronto PreSale market from Q1 of 2024. This was at a time where I was really starting to realise how dire the situation was for this market. There was 1,500 condos sold in that quarter in the first quarter of 2024. And this was already 71% below the 10-year average. And it was 85% below the peak of Q1 of 2022, a quarter in which 10,000 condos were sold. But the figure that really blew my mind was that there was 12,000 new condos came to completion. And although it had already been reported by Urban Nation that there could be as many as 40,000 condos coming to completion for the entire year of 2025, I didn't expect such high numbers for completions of condos as early as the beginning of 2024. It was 2025 that was due to be the all-time record high for condo completions in the GTA, with an additional 32,000 units coming to completion in 2026, which would have been our second highest year ever for completions. And then we need to consider the fact that a non-insignificant amount of these condos which are coming to completion are either still unsold and still owned by the developer, or they were purchased by investors who were hoping to sell or assign the contract for these units before completion. In addition to this, I was very worried then, and I'm still very worried now, that we may get to a point where these investors will find it very hard to close on these units upon completion of these projects. Remember, at the peak, these investors agreed to pay a 30% premium versus current market value for these condos at the time that they signed the contract to purchase these units. And not only have prices not gone up since the peak of Q2 of 2022, but in actual fact, prices have come down since then. We can now see that resale condo prices on the MLS are down over 13% since Q1 of 2022 and the last quarter, which was Q2 of this year, 2025. And this equates to a loss of over $100,000 for the average condo. And we can see from the bottom right of the screen that prices are down 6% in the last 12 months alone. So we can now see from TREB's data that the decrease in prices for existing condos in the market has started to accelerate in recent times. So those who purchased pre-sale condos a number of years ago could very easily find themselves in a situation that they'll be closing on a condo that's no longer worth what they'd agreed to pay for that condo when they signed the contract to purchase that pre-sale unit. And if the difference between what they agreed to pay and the value of the condo upon closing becomes so large, then the banks may be unwilling to give them a loan for the amount that they agreed to pay for the apartment. As an example, if someone had agreed to pay $800,000 for a one-bed apartment in Q1 of 2022, and if they put down a 20% deposit over the last few years, which would equate to $160,000, upon completion, if the apartment was still worth $800,000, the bank would be willing to loan them 80% of this amount, which would be $640,000. Then, with this $640,000 from the bank, plus the $160,000 deposit that was paid, This would equal $800,000, which was the full amount that that purchaser would have agreed to pay for that apartment. However, if that same purchaser of that same apartment, who had paid $800,000 for it with the $160,000 down, if that apartment had failed to go up 30% premium that that purchaser had paid, meaning that that apartment was still worth what the current day market value was back then, which was $615,000 in this example, the bank may only be willing to give them a loan for 80% of $615,000, which would be $492,000. So if we were to get this $492,000 from the bank plus the $160,000 of a deposit that was put down, this is equal to $652,000, which is $148,000 short of what the purchaser had agreed to pay for this condo. And we can very easily envisage a situation where these purchasers may be unable, and even if they were able, they may be unwilling to put down an extra $148,000 on top of the $160,000 that they've already put down in a deposit. So this doesn't seem to have become a major issue before now, but this is because it is very well documented that these banks have been offering blanket appraisals on these units. These banks have basically been appraising these units at the exact same price that these purchasers agreed to pay for these units when they signed the contracts to purchase them, regardless of the fact that this is well above the current day market value for these condos. And I'll go into more detail in another episode on why the banks found themselves in a situation where they pretty much had to do this. In short, if the banks didn't offer these blanket appraisals, then many people would have found it impossible to close on these units. And if this were to happen at scale, then the bank would be putting a much larger lender of theirs at risk of defaulting, which would be the developer. It is the very same banks who provide mortgages to individuals and households like us that were also the same banks that finance these developers for the building of these projects. So it seems as though we haven't gotten to this point just yet. And I very much hope we never get to this point, because if we do, I believe we'll be in very serious trouble then. But let's put all this aside for now, and once again, let's just bring our attention back to the fact that the current dynamics for supply and demand in the market are already looking very unfavourable, even without considering if any of these people will be unable to close on the condos that they agreed to purchase a number of years ago. So now, just as we have done for supply, where not only do we look at current supply, but we've examined the future trajectory of supply, let us now do the same for demand. And as we already know, demand for pre-sale condos in Toronto is already 95% off the 10-year average, and at lows not seen since the mid-1990s. But now let's question where we believe demand will go for here, and to do this we'll use a tactic that we used in the last episode, where we put ourselves in the position of a purchaser in the bond market. Let's now put ourselves in the position of a purchaser in a pre-sale condo market in Toronto. And as the majority of these purchasers are investors who are purchasing these units with the hope of renting out these units, let's put ourselves in that exact situation where we are a purchaser who will be purchasing this unit with the intent of renting out this unit once we receive completion of the condo. You may remember that we already spoke about rents in the very first episode of this podcast, where we spoke about rents for the purpose of working out the cash flow on an investment property. Back then we had mentioned that the rental market had peaked in terms of average asking rents in the fall of 2023. I was in the market myself at this time, and I was looking for a one-bedroom apartment in the downtown Vancouver area. And the going rate at that time was, sure enough, $3,000 a month for a one-bedroom apartment. And options were scarce, but I came across a one-bed in a slightly older building on the south side of Falls Creek, right beside the Cambie Bridge, and it was being offered for $3,000 a month. And I decided simply by looking at the pictures online that this was an apartment that I wanted. It was a Thursday evening and I was in Toronto from work, but I called the listing agent from Pearson Airport before I flew back to Vancouver, and the first thing I said on the call is, what did I need to do in order to secure this apartment? The agent said that there was a number of people coming to view that apartment that evening and that I should come along as well, but I said that I wouldn't be able to be there until the next morning as I was flying back from Toronto for work. The agent said that the apartment would be gone by then, and at this point I offered them the entire first year's rent up front. I was adamant that I wanted this apartment. I'd been in the market for a while and options were scarce, and any good apartments that did come online were snapped up right away. And then the listing agent said that this apartment was likely going to go into a bidding war, and that if I really wanted the apartment I'd have to offer more than $3,000 a month for this apartment. And at this point in time I decided to postpone my search. It was evident to me that the market was in a state of mania, with average asking prices for average one beds around the downtown area being $3,000 a month, and they were still finding themselves in bidding wars. And it was no wonder that the rental market was so tight at this time, because our largest ever annual increase in Canada's population growth was in 2023, where we grew the population by 1.27 million people in that year. And it was the second largest year ever in terms of percentage population growth, where we grew the population by 3.2% in that year alone. And this was behind our largest ever year in terms of percentage population growth, which was 3.3% in 1957. And before 2023, 2022 was our largest ever year for population growth in Canada by absolute numbers, where we brought 1 million people into the country in that year. So the fact that we had a rental crisis at the end of this 2-year period was no surprise whatsoever. Because we already know from the second episode of this podcast that we'd be doing extremely well to add 250,000 homes to our housing stock in any given year. So the numbers simply didn't work. The government of Canada were inviting over 1 million people to our country in 22 and in 23, but we'd nowhere to house them. It was like preparing a meal at home for 10 people and then inviting 40 people over to eat. But now we are in a completely different situation. And in a recent report by the Financial Post in an interview with Urban Nation stated that 65% of the purpose-built rentals which were built in the GTA since the year 2000 are now offering renters incentives to entice renters to come and choose their apartments to rent out, with 1/4 of them offering 2 months free rent. And once again, this was perfectly foreseeable, because the population growth of Canada has now pretty much completely stagnated. And it should come as no surprise to anybody that this has happened, because it's been well over a year since our government announced their plans to bring population growth to zero for this year and for next. And this stagnation of population growth is coming at a time where we have a record number of purpose-built rentals under construction and coming to completion right across our country. Here in BC, the amount of rentals under construction is 15% of the entire current purpose-built rental stock. This could be buildings that are 5 years old, 10 years old, 20 years old, or 40 years old. And 15% of this total purpose-built rental stock is under construction and will be added to the market in the coming years. As well as having a record number of condos which are owned by investors with the intent to rent out these units, which will also be coming to completion over the next few years. And all this is happening at a time where our population growth is zero and is actually declining in Toronto and Vancouver. And the difference between adding 1.27 million people to our population and adding nobody to our population is massive. The only renters who will be potentially occupying these new units are renters who will therefore be leaving another unit vacant. So for the purchasers of these units who purchase these units at peak pricing, and do be aware that those that purchase at peak pricing, most of them haven't closed on their units just yet and won't for another 12 to 18 months. But these future investors will find themselves in a negative cash flow position to the tune of $1,000 to $1,500 a month or more if they find a tenant to pay top dollar for their unit. And for those that can't find a tenant, well, they'll be out another $2,700 a month. And I do maintain that it'll get much harder to find tenants once we go through a substantial period of time of zero population growth. Just like we went through 18 months of massive population growth before we hit the peak in our rental crisis, which was in the fall of 2023. And then we have the investors who purchase these condos with the intent of assigning the contracts for these condos, or reselling these contracts, or flipping these condos before the building was complete. And reselling these contracts has proven to be almost impossible to do over the last 3 years without incurring significant losses. And then we have the sector of condos that worries me the most, which is the large amount of unsold condos under construction and coming to completion, also known as the shadow inventory. It's known as the shadow inventory as it's not on the MLS, and it's therefore hidden from the public and also hidden from the various real estate boards across the country. So let's now look at an interaction in the pre-construction market from the point of view of the purchaser. And as the average purchaser may not know that the sales of these new condos in Toronto are down 95% from the 10-year average, or that the supply of these units in the market is going to approach an all-time record high in the coming months. So let's put these pieces of information aside for now. Let's simply consider that we will be choosing to purchase an asset, the price of which is falling and has been falling now for 3 years, And if we were to purchase and hold this asset and rent it out with the hope that prices would start going up again, we'd be choosing to hold an asset with a monthly carrying cost or negative cash flow of $1,000 to $1,500 negative a month or more. And we'd be choosing to do this at a time in which uncertainty regarding the future of our economy is at multi-decade highs, and unemployment is rising and is already at 9%. And if we were to choose to purchase one of these pre-sale condos, we'd be choosing to purchase a condo which is still priced at about a 30% premium to other existing and essentially new condos which are also on the market. These pre-sale condos are still being sold at a price of about $1,300 per foot or more, and we've a record number of resale condos on MLS. Condos in recently completed buildings that are being sold for about $1,000 per foot. So now we might have an opinion of where demand may go from here, or as demand is already at 30-year lows in this sector, it may be more of a case of where demand may stay. And from previous episodes, we've already spoken at length about the future trajectory of supply. And it is supply that is the one that we can be more sure of because it's far easier to calculate. And it's not affected by other variables such as consumer sentiment or the future health of our economy. And any building that's completing soon is a building that's already under construction. And as I said from the very first episode of this podcast, I believe it'll be this year, 2025, that'll be our all-time record year for completions or the delivery of new homes in Canada. Not just for Toronto PreSale condos, but for all housing unit types collectively across our entire country. So that is the current state of the Toronto pre-construction condo market. And on the next episode, I want to speak about something which also came up many times in today's episode, which is population growth. And after 3 years of massive population growth in Canada, and now being in the early stages of 2 years where we're not going to have any population growth at all, I think this is something that can have a massive effect on the overall Canadian economy. I was out celebrating the 10-year anniversary of my Irish football team here in Vancouver in the spring of last year, and I was talking with a friend who works in finance at the bar, and the two pieces of information I felt the need to pass on was the Q1 update from the Toronto condo market, as well as making the point that I believe that the Government of Canada's new immigration targets was something that was going to have a massive negative effect on our overall Canadian economy. Because I believe one of the main things that has kept Canada out of recession over the last 3 years has been our massive population growth. Because for the majority of the last 2.5 years, Canada has already been in a per capita recession. And it was increasing our per capita count so substantially that was one of the main things, in my opinion, that kept our GDP in positive territory. But now, by having removed population growth from the equation completely, with all else being equal, I think it'll now be very difficult for Canada to stay out of a recession. And after having experienced negative GDP growth in the last 2 readings for April and May, we already could be well on our way to being in that recession. And I believe if Canada is confirmed to be in a recession, this is one of the last nails in the coffin for the Canadian housing market and certainly for the Toronto pre-construction condo market. So I'll dedicate the entire next episode to look at the history of our population growth in Canada throughout time. And if you'd like to see that episode, please hit like and subscribe, and we'll see you all again soon, hopefully.